Can you make money with real estate? There's a lot of hype on social media about how easy it is to make money through short term rentals or even get tax benefits with cost segregation. But can you actually make money with real estate? I built a financial model that looks at cash flow, net operating income, and your equity accrued over the life of the mortgage so we can really understand whether you can make money or not in real estate. We're going to go through an example today so we can really see whether or not money can be made.
To start, I'll just orient everyone around what the sheet is. So you have a lot of your high level assumptions up here. So everything here is really related to your cost assumptions, how much the purchase price is, any improvements you want to make up front, closing costs. It's a formula. It assumes 6.3% as the buyer. However, you can also adjust this to what makes sense for you depending on what market you're in. Down payment assumptions, interest rate, mortgage, time frame, as well as your revenue assumptions, occupancy rate, your purchase information, and a lot of these are actually calculations. And then if you do want to sell, I do have some assumptions here that you can input that would help you understand what you're actually getting as a net profit from the sale. And then this home info is more just good information to have regarding the square footage, the number of beds and baths that you're investing in. When you scroll down below, this actually lays out all 30 years for you. So this is assuming the life of the mortgage. What does your P&L statement almost look like for this investment property over this time frame? I'm not going to focus on all the details here. What I am going to tell you is that I've actually used this for several investment properties in my portfolio, and this is how I make my strategic decisions on what to invest in and why.
We're going to start with the Jacksonville Beach property, which is located in Northeast Florida. Jacksonville's housing market was actually undervalued prior to 2020, but since COVID, like many Florida cities, have seen a huge rise in property values. Let's see if it's still worth it for us to buy here. At first glance, this does seem like a very typical short term rental property. Oh, you can even see that they're actually offering up to $12,000 worth of buyer's closing costs if you go with a preferred lender. Oh, another bad sign here actually is that this has been on Zillow for 194 days. So there hasn't been a lot of interest on this property. That already can give you a slight hint as to how it's going to perform as a short term rental. The one good note here is that it is relatively close to the beach. You're roughly around 7 blocks away, so flooding doesn't become a concern, but you're close enough that you can walk and bike. Let's take a look at the property itself. Pretty standard new construction. I do feel like new construction now really looks the same across a lot of properties, but it does give you the opportunity to kind of decorate this in the way that you would like. Let's take a look at some numbers now. I have added some of these assumptions in already, such as the purchase price, the closing costs remain unchanged. The down payment is assuming 20%. Typically, for investment properties, you get the best mortgage rate at a 25% down payment. If you do want to put less than 20%, it is possible. However, my calculations don't assume a private mortgage insurance or a PMI, which you will need to pay if you put less than 20% down. I inputted interest rate assumptions in here. Now, this will, of course, vary as well, depending on your down payment and how great your credit score is and what your history looks like. The typical mortgage time frame is 30 years. I leave that on all my investment properties. There's no reason to get like a 15-year mortgage loan when a 30 is available. Next is your purchase information. Your purchase date and your rent or revenue start date will directly impact your year one calculation below. So having this information as accurate as possible will help you get a better financial picture.
But today we're really going to focus on the revenue assumptions and where to pull this from.
I purposely like to use Rabu for this as they do give pretty detailed projections and you're able to select the comps in your area. So what I did here is I actually reduced the radius down to 0.5, so half a mile away, and required that the average rating was a minimum of 4 stars. You'll see some of these gray shaded items. These are Airbnbs that have pools. Because the property we are looking at does not specifically have a pool, we are not going to include any houses with pools as comps. If you do want to add a pool in the future, having these average daily rates is useful to really understand what your ROI is of adding a pool in. But for now, we are going to assume that we are buying the property as is. We will not make any improvements and see what we can get for the average daily rate comps right now. Looking at the annual projection, it looks like this will net out around $48,000 per year. If you actually scroll all the way down, Rabu does include a year one cash on cash and cap rate calculation. I purposely like to look at the investment over a 5 to 10 year horizon. So this doesn't necessarily do much for me, but it does give you a good sense of whether or not you'll be making cash right away. Back to the spreadsheet. What we're going to do is enter in the average daily rate as well as the occupancy rate here. I'm actually going to adjust this slightly and go a little bit higher to around 378. I do think we can squeeze a little bit more out of this than what Rabu currently shows. All right, let's scroll down to the fine print. What does it show? It is showing negative cash flow, and it is negative cash flow for actually quite some time, up until year 11 or 2036. I don't know about you, but that does not sound like a really great investment to me.
You're going to have to support this property and spend this amount of money each year in order to sustain it, which I don't know how many people can, over a 10-year period, basically spend $75,000 keeping a property that is supposed to give them cash flow.
Let's say we change this interest rate to maybe like 4%. That actually changes the calculation quite a bit. You're cash flow positive closer to like year 4. And with some cost segregation, potential opportunities, and tax benefits, this might actually make sense as an investment property. Until that happens and until the rates go down significantly enough, or this purchase price comes down significantly, this property does not make sense as an investment property.
And this is why it's important to do an analysis, because if you do not, you can end up buying a place that takes up all of your money and time and does not generate what you would expect back.
If you enjoyed this walkthrough, visit my Etsy store to buy this real estate investment tool. It is only $20 and it'll be the best $20 that you've ever spent.